put out a Asia report at McKinsey, and I thought there were some interesting details in that. For instance, Asia accounted for over $1 of every $2 in new investment over the past decade.
That's right.
But that was mostly dominated by China?
It is dominated by China, but not only China. So you're right. We've just released a report. It's called Corporate Asia, a Capital Paradox. And the reason we say that is, as you rightfully point out, there's been a huge amount of investments globally, but also in Asia. $1 out of every $2 has been invested in Asia over the last 10 years. A significant part has been in China. If you look globally, that's been about 1/3 has gone into China. But that means that there's still a lot of money that of investment that has gone into the rest of Asia. The paradox is that a lot of that has been into value-destroying sectors.
And India is, in fact, been amongst those countries which has seen a considerable amount of that value destruction. So let me put it in context. On the basis of the numbers that you all have put in, Asia accounts for half of the global deterioration in economic profit. The global deterioration being from somewhere from between $726 billion to now negative $34 billion. And there are sectors that have contributed to this deterioration, and then there are countries that have dominated this. So let's talk a little bit in detail about what your insights are on this, and then I'll get to the India question.
So, first, I think it's important to understand what is it we are measuring. So we're talking about economic profit, which is basically the profits generated by companies minus their cost of capital. So it's important just to establish that to start with. And you're right, over the past 10 years, we look at a 2-year period, 2005 to 7 versus 2015 to 17. In that time frame, the economic profits have dropped from positive 700 plus billion worldwide to a negative 30 plus billion worldwide. Half of that drop has happened in Asia. Now, if we stay at the global level first, there are 3 things that have disproportionately led to this drop. Number one is energy and materials investments globally, anywhere in the world. Those have, by and large, in most countries, been value destroying. We used to have a super cycle in the 2005 to 7. Now those have been value destroying in that time frame that we looked at. Secondly, is European financial institutions account for another large part of the 700 decline. And thirdly is China in itself is also is a huge part of the downward drive. As I mentioned, 1/3 of all investments happen in China. Almost $10 trillion of investment in China. 80% of that has been in value-destroying sectors. So that gives you a little bit of a picture of the global, what causes the global downdraft, so to speak. Having said that, we see value creation in pockets in all countries. There are some sectors in most countries, and we see some sectors globally that have been very positive. For example, in the IT and the tech space globally, we've seen that has been a value creator globally. We see pockets in Japan, the capital goods sector, which means investments into heavy manufacturing, automotive, chemicals, has been value creating. We see that tech investments into Japan, Korea, China have been value creating. Even if you take energy and materials, which I mentioned was a large reason for the downward drop, in some places like Southeast Asia has actually been a positive value creation.